Welcome everyone to the Vested Interest channel. This is Shane back for our last stock pick of the day video. We are going to take a look at one out of the industrial sector. This is an aerospace company, GE Aerospace, should be right there in the name, so you know what they do. Defense contractor. Now you may know them from their time as General Electric, where they made a lot of appliances and some electrical equipment. But they've spun off that portion of the business. Now they are just a defense contractor around specifically the aerospace sector here. So a little bit different from your grandma or grandpa's GE, what they might remember them from. But they have been in the defense space for a while, and we'll see that here in this video. Now, this is the vested interest stock screener. This is the criteria we will be running through in the video. We'll check it out in the screener at the end, see how it shakes out. And it must meet 5 of 8 to make it on my watch list. Now, keep in mind, this is just an initial screener. It is not a deep dive into the financials. We are not going to be looking deeply into their books, into their balance sheet, their income statement. We won't be running a discounted cash flow analysis on the company. We won't be comparing them to other competitors, which is what I would do if I was doing more of a deep dive. And if it makes it onto my watch list, that would be the next step in the process before I decide whether I'm willing to buy or sell the stock. Again, just an initial screener, and you can tweak this, take this, make it your own, but this is my screener. All right, you can check them out on their homepage, www.geaerospace.com. That's www.geaerospace.com. That is their homepage where I pulled this information from. There's an old photo there. When the United States entered World War I, right, way back in 1917, the U.S. government searched for a company to develop the first airplane engine booster for the fledgling U.S. aviation industry. This booster, or turbo supercharger, installed in a piston engine, used the engine exhaust gases to drive an air compressor to boost power at higher altitude. GE accepted the challenge first, but another team also requested the chance to develop the turbo supercharger. Contracts were awarded in what was the first military aircraft engine competition in the U.S. Under wartime secretary, both companies tested and developed various designs until the Army called for a test demonstration. In the bitter atmosphere of Pikes Peak, 14,000 feet above sea level, GE demonstrated a 350 horsepower turbo-supercharged Liberty aircraft engine and entered the business of making airplanes fly higher, faster, and with more efficiency than ever before. That mountaintop test of the first turbo-supercharger landed GE's first aviation-related government contract and paved the way for GE to become a world leader in jet engines. So again, may not be what they were known for back in the day, but certainly they've been in the game for a very long time. 100 years, powering a century of flight. That's 100 years. A little over that now, since they started back in 2007 or 1917, and we're in 2025. So a little over 100 years, but they've been in the game for a while. But now they've branched off or spun off the portion of the business outside their aerospace focus. I believe that spinoff was a couple years ago now as well. All right, the reason we're taking a look at them, huge drop on the day, down 7.38%. We are talking about GE Aerospace, ticker at GE, closed up the day at $295 even there. It looks like this is the after hours. I don't know why it's messed up like that, but on Yahoo Finance, it was on every single page jacked up, so their readout is just funky right now. But that looks like the after hours numbers. Look like they're bounced back a little bit, but after hours goes towards 8 o'clock, so it could bounce around here for the next several hours. 52-week range as low as $159.36, as high as $332.79. So even with the 7+% drop on the day, huge drop on the day, they are still closer to their 52-week high than their 52-week low, and they are not remotely close to 15% of their 52-week low yet. Need to drop under that $200 and some change mark, really a little lower than that, but definitely have to get under that $200 mark to get back to even close to that 52-week low. A market cap of $312.83 billion, a beta of 1.40. So this is one that is more volatile than the overall market. You might be able to use that volatility to your advantage. They've been on quite a upturn or run up here lately, as have a lot of defense contractors. And maybe we are going to start seeing a pullback in some of them. Definitely one here on GE. A PE ratio, price earnings ratio, 39.44, $39.44 per share. That seems very, very high, very elevated. Need to be growing earnings very, very fast to justify that. That is in line with what you're seeing a lot of tech companies, startups, and something like that. But that is a very high PE. Earnings per share EPS is at $7.48 per share. Earnings date was today. So I'm assuming something around their earnings was not to the liking of everyone out there. Maybe they missed the top or bottom line. Maybe their forecasts were projected down. Not sure. I have not checked out their earnings. But if you are interested in this company, you should look at their earnings and see what's going on. What spooked the market here? Forward dividend is $1.44. They're a quarterly payer, so divide by 4, though we will see that here towards the end of the video. Starting yield is very low at 0.45%. Again, they did do a spinoff, so they are still paying a dividend, but it is much lower than it used to be post-spinoff. Ex-dividend date, December 20. And to be honest with you, you should go look at that spinoff as well. Where did the debt go on this company? I think that was the reasoning behind the spinoff, to get rid of some of that debt, to streamline their business instead of focusing on a lot of different things, to be more specialized in one area. So you should understand what that spinoff, how the split affected the overall debt that's on the books for both, if you're interested in the spinoff or if you're interested in GE Aerospace. Ex-dividend date, December 29th. We are past that. Looks like they're going to pay out here on the 26th. So kudos to those of you who held shares before the December 29th date there. You will get that dividend here. What is that, next week? Yeah, that's next week. And a one-year target estimate, at least according to Yahoo Finance, $354.82. So they do see some potential upside from where it currently sits, and potentially hitting a new 52-week high as far as Yahoo Finance is concerned. Now, jumping over to the right, I like to look at dividend yield theory to see if the company is potentially undervalued. Now, they did the spinoff, I think, a couple years back now, but a lot of this will be based on the full company before that spinoff. So you're going to see that they have 5 years of dividend yield average, even though that spinoff was within the last 5 years. Whenever these companies like GE, for example, or Abbott spun off, Abbott Laboratories years back, they did the same thing. You'll see it's a continuation on the previous company dividends, even though they're two separate companies now. So they do have enough data to meet the 5-year threshold, even though the spinoff was within the 5-year time frame. 5-year dividend yield average is 0.38%. We compare that to their current forward annual dividend yield, 0.45%. Current is 0.45%. Since it is higher than their 5-year average, that speaks to potential undervaluation. Now, again, the spinoff is going to skew these numbers a little bit, so this one might be one where I wouldn't trust dividend yield theory as much. And it's just one metric. You should not just blindly buy based on one metric. You should be looking at the company as a whole, and this is just an initial screener, so keep that in mind. But right now, according to dividend yield theory, it says that potential undervaluation. Again, according to dividend yield theory. Payout ratio is low at 18.18%, so they've got a lot of runway to continue to raise that dividend over time, and I would expect they are going to continue to do just that with such a low payout ratio and with a history of raising dividends in the past. Free cash flow, I like to look at free cash flow. Companies can do some things with that free cash flow. They can pay down debt, they can make acquisitions, reinvest back into the company, buy back shares, pay a dividend, which this company does, raise that dividend over time, which as a dividend growth investor, that's what I want, and they can even hold some of that cash on the balance sheet as cash or cash equivalents. Now you can see here going back to December 2022, $5.2 billion in free cash flow, 2023, $4.3 billion. It looks like a drop there in 2024 to $3.6 billion. But again, you're going to want to look and see where exactly they did the spinoff. You probably will see a drop because of the spinoff, but it does look like in the trailing 12 months, they are back on the upswing to $6.4 billion. Repurchase of capital shares, 2022, $1.1 billion, 2023, $7 billion, huge repurchase of shares in 2023. So I would actually say maybe there wasn't a decrease in free cash flow in 2023. It looks like they took a bunch of that free cash flow and bought back a huge tranche of shares and continued that in 2024, $5.8 billion, trailing 12 months, $7.2 billion. So again, another banner year in 2025 of repurchase of shares. Not only was their free cash flow up, but they took a lot of free cash flow and continued that aggressive repurchase of shares that they have been doing since at least 2022. Now, jumping over to stockanalysis.com, this is another source I go to for information. Not affiliated with stockanalysis.com, not affiliated with Yahoo Finance, just two sources I go to. I do recommend 2, if not 3 sources, so you can make sure the information you are looking at is accurate and up to date. I do not ever, and I recommend you don't either, ever blindly just trust one source. Make sure you're looking at multiple sources out there. Again, sometimes information is not updated in a timely manner. Sometimes it's just wrong. It does happen. We're all human. We make mistakes, and sometimes what you see online is not accurate. Now, they do have 10 analysts that have taken a look at this over at stockanalysis.com. They called a strong buy, low estimate of $222 would represent a 24.75% decrease from where it currently sits, and that would definitely put them within that 15% of a 52-week low, dropping down, or I'm sorry, no, it wouldn't. Even at their low $222 estimate, it needs to drop under 200 to get back to that 159, I think it was, 52-week low, but this would be a much better buy price with a 24.75% decrease than where it currently sits. Average estimate of $318.70. That would represent a potential 8.03% increase from where it currently sits. And if it happened to hit their high of $378, not too far off what we saw with Yahoo Finance on the previous page, that would represent a potential 28.14% increase from where it currently sits. Couple statistics I like to look at right here as part of the initial screener: return on capital employed and earnings per share growth. For return on capital employed, I like above 10%. Now they're at 9.62%, so not quite there yet for return on capital employed. And EPS growth forecasted over the next 5 years, I like above 5%. They're at 11.76%, so they do beat that metric there. All right. Looking at their dividend history, quarterly payer, 19.2%. So here's where some discrepancies show up, right? 19.2%. I think the Yahoo Finance had them at 18%. So not a huge discrepancy, but a discrepancy nonetheless. So you might look for a third source. Is it 18%? Is it 19%? Again, not a huge discrepancy. But let's say this was 25% or 30%. Then again, that's where that third source would come in. Now, they are showing dividend growth, very aggressive dividend growth, 28.57%, very, very high. I don't know if they'll keep that up, but with such a low payout ratio, they could keep it up for a while. Growth in years, 2 years of dividend growth, so it must have been about 2 years ago they did that spinoff. Buyback yield is positive at 2.26%, so they are aggressively buying back shares, and they are pulling more shares out of the market than they are issuing. Shareholder yield is positive at 2.74%. They do pay off schedule for most companies on the January, April, July, October timeframe, so this would be one of those companies that would help balance out your payments throughout the year without having monthly payers. Going back in time here, September 25th, 2023, they were paying 8 cents. Raised that up April 12, 2024 to 28 cents. Raised that up again March 10th, 2025 up to 36 cents. So there's that aggressive 8 cents, 28 cents, 36 cents. Very aggressive dividend growth, 28.57%. Really like to see that, especially with such a low payout ratio. It really bothers me sometimes when I see companies with such a low payout ratio but still have slow dividend growth. I will use Google as an example. Even though they've only paid out for a couple years now, their dividend growth of only 5% really bothers me because their payout ratio is even lower than GE's. So I'd like for companies like that with such low payout ratios to match that with very high dividend growth, which this one does. All right, let's wrap this one up, run them through the screener here. Again, understand the business. Yes, this is an aerospace company. Like I said, they spun off their other division that made a lot of electronic equipment or household items, GE washers, dryers, that sort of thing back in the day. But that is a separate company now. They are just focused on the defense aerospace side of the business. That is what GE Aerospace is now, a defense contractor. Growing free cash flow, I'm going to say no, even though it looks like maybe you do the math, maybe they're not quite as up and down, and you've got that down year a couple years ago because of the spinoff, but it definitely looks like recently, last year, they had a banner year, very aggressive repurchase shares, utilizing that free cash flow to repurchase a significant amount of shares on this one. Growing dividend, yes, they are growing the dividend very aggressively, double-digit dividend growth, nice to see with such a low payout ratio. Payout ratio is under 75%, under 20% actually, so check there. Dividend yield theory says they are potentially undervalued right now. Check there. Again, I question that one because of the recent spinoff, but we're going to give it to them. They are not within 15%. I should have taken that one out. They are not within 15% of a 52-week low, so we should have that one taken out. Return on capital employed, no, they weren't quite there. 9%, but not quite to 10%. Earnings per share growth was over 5%. So if we remove buy below current cost basis or within 15% of 52-week low, we're still looking at 1, 2, 3, 4, 5. We'll take that one out because it's not there. 5 out of 8 does put them on my watch list. Would like to see them bring that return on capital employed up a little bit, but at 9%, they are very close to that 10%. So this one is going to go on my watch list. I would do more of a deep dive into the financials on this one and see what's going on. I would like more of a pullback closer to that 52-week low before I'm really interested, depending on what a discounted cash flow analysis says, which I haven't done on this one yet. But let me know what you think of GE Aerospace. Is it on your watch list? Is it on your buy list? Is it a hold or a sell for you? Let me know in the comment section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you've got a company like GE Aerospace you'd like me to cover in the Stock Pick of the Day series, drop it down there. I'll work it into the rotation on a day it pulls back, probably on a day it pulls back. I have done some recommendations on days that they were up, but most of the time it's on days they pull back. Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend coming up, and we will see you in the next one. Stay warm out there. There is a huge cold front coming in, and I know here in Michigan, below zero, negative temps over the next several days. So stay warm out there. Hey, I'm not a financial advisor. Nothing in this presentation should be considered financial advice. So I'm only sharing my opinion. Investing for educational and entertainment purposes. Investing involves risk. You can't lose money. So never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria. Always seek the advice and counsel of a certified financial advisor.